Order! Order! You are an incorrigible delinquent at times. Behave yourself, man!
Good morning, Mr. Johnson.
Good morning.
On the 7th of February, you said leaving would cause at least some business uncertainty while embroiling the government for several years in a fiddly process of negotiating new arrangements, so diverting energy from the real problems of this country. How long do you think this period of uncertainty would last?
Well, I think the first point to make there is that I do think it's important in this whole debate not to blame every problem in this country on the EU. And I don't. I think that there are...
That's not what I asked you. I asked you how long the period of uncertainty would last.
I don't think that it need last very long at all. In fact, I don't think there need be a period of uncertainty at all. When you consider that, I think the best analogy I can come up with this whole debate
so you're suggesting...
if I may just finish, is the millennium bug, the Y2K alarmism. And people said that planes would fall from the sky and that computers would crash and the economy would tank by 5% or something. Nothing of the kind took place. I think there is a great deal of scaremongering and alarmism.
On the day that you came out for Brexit, the pound fell, supposedly because you are a very effective communicator, and that made it more likely that Brexit would happen. When the governor of the Bank of England came and gave evidence to us on Europe, he described Brexit as the biggest domestic risk to financial stability. He said there would be volatility in the foreign exchange markets and downward pressure on foreign direct investment, on investment particularly in tradable goods, and on household consumption. Are you not concerned that a period of uncertainty in the British economy would have those effects?
Well, we've heard this. First of all, I don't believe that. I've looked at FDI into London at the moment, what's going on, confidence in the city, what's happening with our economy. No sign whatever of people being discouraged from investing, coming to London. That remains massively strong. So I'm not quite certain what this period of uncertainty is that you speak of. I seem to remember that, when we were considering whether or not to go into the euro, and thankfully made the right decision not to do so, people were saying very much the same sort of thing. And it didn't transpire. On the contrary, London flourished, prospered as never before.
Okay.
And I have to say, I think that the pound, if you ask me about the pound will be as strong and as robust as the UK economy. And my view is that the risks are in remaining in the EU. If you look, why should we remain tethered to this anti-democratic system?
I'm not now asking you questions about the long term. I'm asking you questions about the short term. The period before we've agreed our relationship, the period before we've agreed our new relationship with the EU, the period before we've negotiated 50 new free trade agreements, when the governor of the Bank of England is telling us that there would be volatility in the foreign exchange markets. This would have a detrimental impact on foreign direct investment, on investment in the British economy, particularly in the tradable goods sector, and on household consumption. Now, if you could just look beyond the City of London, in the North East, we have 140,000 manufacturing jobs dependent on exports to the EU. And Nissan and Hitachi, the two biggest foreign direct investors, have both said they would not invest more in the event of Brexit. Do you think, therefore, it is responsible to dismiss as airy-fairy these concerns about uncertainty and the impact on investment?
Actually, you're wrong about Nissan, certainly, because they've changed their tune since the euro controls. And as far as I can remember, Nissan have said that they would continue to invest irrespective.
No, Nissan have not said that. What Nissan have said is that they would not close the current factory, they would not move it, but they would not put any new investment in. And we get £27 billion of foreign direct investment into this country every year, and a period of uncertainty while you were deciding what a British deal meant would undoubtedly mean that we lost investment for a period of perhaps 2 years. Don't you think that that is a worry for those people who have jobs in the North East in manufacturing?
I think it shouldn't be a worry, and I hope very much that people will do their best to persuade those who are anxious that there's no reason for them to worry.
Good afternoon, everyone. The decision to leave the European Union marks a regime change. In the coming years, the UK will redefine its openness to the movements of goods, services, people, and capital. And some of the adjustments to this new reality may prove difficult, and many will take time. But the UK can handle change. It has one of the most flexible economies in the world. It benefits from a deep reservoir of human capital, world-class infrastructure, and the rule of law. And its people are admired the world over for their strength under adversity. To be clear, the future potential of this economy and its implications for jobs, real wages, and wealth are not the gifts of monetary policymakers. We cannot immediately or fully offset the economic impacts of a large structural shock. However, monetary policy can support the necessary adjustments of the UK economy during a period of heightened uncertainty. And that's why, at its meeting yesterday, the MPC agreed an exceptional package of measures comprising, first, a 25 basis point reduction in bank rate to 0.25%, a new term funding scheme to reinforce the pass-through of that cut in bank rate to the borrowing rates actually faced by households and businesses, a new program of private sector asset purchases with up to £10 billion of UK corporate bonds, and a £60 billion expansion of gilt purchases. We took these steps because the economic outlook has changed markedly, with the largest revision to our GDP forecast since the MPC was formed almost 2 decades ago. Early indicators are consistent with the risks that the MPC had identified before the vote. And we now face a trade-off between the degree of support we give to the economy on the one hand and how fast we return inflation sustainably to target on the other. By acting early and comprehensively, the MPC can reduce uncertainty, bolster confidence, blunt the slowdown, and support the necessary adjustments in the UK economy. The degree and composition of that stimulus is largely determined by the effects of the vote to leave the EU on demand, supply, and the exchange rate. So beginning with demand, the 9% depreciation of sterling since the referendum will boost exports and weigh on imports. However, even though the MPC expects the current account deficit to have, over the next 3 years, improvements in the external sector are not expected to offset fully the drag from substantially weaker private domestic demand. The MPC expects several factors to weigh on investment in the near term and on employment and consumer spending over time. These include a protracted period of heightened uncertainty, weaker activity in residential and commercial real estate, and a higher cost of capital for UK-focused firms. Some of these effects are beginning to manifest in surveys of investment intentions, business activity, and the housing market. These indicators have all fallen sharply, in most cases to levels last seen in the wake of the financial crisis, and in some cases to all-time lows. The MPC has been conservative in its interpretation of these data, producing a forecast stronger than historical relationships would have implied. Nonetheless, we expect aggregate demand to grow only a little over the next few quarters before picking up to rates below those projected in May. The extent to which this lower path for aggregate demand is likely to be accompanied by a lower path for aggregate supply is a key determinant of the inflation outlook. The weakness in demand will itself weigh on supply as a period of low investment restrains growth in the capital stock and productivity. There could also be more direct implications for supply from the decision to leave the EU. The UK's trading relationships are likely to change, but precisely how will be unclear for some time. If companies are uncertain about the future impact of this on their businesses, they could delay decisions about building capacity or entering new markets. In addition, in anticipation of the UK's new trading arrangements, a period of resource reallocation could be necessary as some sectors of the economy expand and others contract. As a result of these factors, the MPC expects supply growth to remain well below past average rates throughout the forecast period. The combination of these demand and supply factors means that cumulative GDP growth is expected to be 2.5% lower by the end of the forecast period than was the case in May. On balance, even after stimulus, a margin of spare capacity is expected to open up and the unemployment rate expected to rise from its current level of 4.9% to around 5.5% over the next 2 years. The fall in sterling will push up on import price and consumer prices, notably over the next 3 years. Indeed, despite the much weaker outlook for activity, CPI inflation in 2 years' time is projected to be higher than expected in May, reaching 2.4% at both the 2- and 3-year points of our forecast. The MPC's remit recognizes that when the effects of shocks persist over an extended period, the MPC is likely to face an exceptional trade-off between returning inflation to target promptly and stabilizing output. When this is the case, the remit requires the MPC to explain how it has balanced that trade-off, including the horizon over which it aims to return inflation to target. Fully offsetting the persistent effects of sterling's depreciation on inflation would require exerting further downward pressure on domestic costs, and that would mean even more lost output and a total disregard for unemployment. In the committee's judgment, such outcomes would be undesirable in themselves and, moreover, they would be unlikely to generate a sustainable return of inflation to target beyond its 3-year forecast horizon. As a result, in order to mitigate some of the adverse effects of the shock on growth, the MPC is setting policies so that inflation settles at target over a longer period than its usual 18 to 24 months horizon. To achieve this balance, the MPC is today implementing a timely, coherent, and comprehensive package of measures. First, the response is timely because the combination of a markedly weaker outlook for the economy and the lags in the transmission of monetary policy dictates the need for stimulus now. For example, cutting bank rate will immediately ease financing conditions for households and firms. Around half of mortgages are floating rate, as are more than 4/5 of bank loans held by firms. Lower interest rates will be felt immediately in this economy. Second, the package of measures is coherent. The MPC recognizes that when interest rates are very low, bank rate cuts might not be fully passed on to the interest rates actually faced by households and firms. Indeed, there have been examples overseas of interest rates on loans increasing when official policy rates have been reduced from very low levels. The MPC is determined that the stimulus the economy needs does not get diluted as it passes through the financial system. That's why it has launched a new term funding scheme. The TFS will reinforce the transmission of cuts in bank rate to the interest rates actually faced by households and firms. Compared to the old funding for lending scheme, the new TFS is a pure monetary policy instrument that's likely to be more stimulative pound for pound. Specifically, it reinforces those bank rate cuts. Secondly, it reduces the effective lower bound for bank rate to close to, but a little above, 0. Thirdly, it charges a penalty rate if banks don't lend. It covers all types of lending, and it's funded by central bank reserves. UK banks and building societies could borrow up to 100 billion sterling over the next year at rates that neutralize the effects that could otherwise cause them not to pass on the new lower bank rate to end borrowers. The coherence of today's package is further enhanced by the FPC's decision today to amend the leverage ratio framework for UK banks by excluding central bank reserves. Effectively, this gets a regulatory constraint out of the way of monetary policy operations without compromising financial stability. It's enhanced by the FPC's earlier action to increase the availability of credit by £150 billion by cutting the counter-cyclical capital buffer to zero and emphasizing the bank's liquidity reserves are usable. And it's enhanced by the PRA board's decision to use regulatory flexibilities to smooth insurers' transitions to new regulatory standards in a very low interest rate environment. And third, this package is comprehensive. The cut in bank rate, the new TFS, the new corporate bond purchases, and the expansion of gilts purchases all work through multiple channels. They are mutually reinforcing, and they're more powerful as a result. In the absence of these actions, output would have been lower, unemployment higher, and slack greater over the forecast period, and the return of inflation to target would have been less sustainable. The purchase of up to $10 billion of UK corporate bonds will support the real economy by directly affecting the financing conditions for companies that make material contributions to UK economic activity. By supporting investment, this action should improve the monetary policy trade-off with inflation. By acting in capital markets, it will be complementary to the TFS, which reinforces the bank lending channel. And by lowering credit and liquidity premia, corporate bond purchases are an efficient means of providing stimulus. Expanding the stock of gilts held in the asset purchase facility by £60 billion will reinforce the transmission of lower bank rate to longer-term market interest rates. In addition, by triggering a process of portfolio rebalancing amongst sellers of long-dated gilts, gilt purchases will transmit to other risky asset prices, easing financing conditions and providing additional stimulus directly. In conclusion, the MPC has worked with the bank's other committees to understand how conventional and unconventional monetary measures interact with the financial system. We've tailored our approach to avoid unintended consequences. This joined-up approach using multiple channels will ensure that stimulus will have maximum impact on the real economy. By acting now, the MPC is supporting the necessary adjustment of the UK economy and ensuring a more sustainable return of inflation to target in the medium term. This timely, coherent, and comprehensive package of measures is appropriately sized given the scale of the shock, uncertainties about the degree of adjustment, and the relatively limited data. All of the elements in this package have scope to be increased. The MPC can lower bank rate, increase the size of the TFS, and expand the scale or variety of assets held in the asset purchase facility. Indeed, if the incoming data prove broadly consistent with the August inflation report forecast, a majority of MPC members would anticipate a further cut in bank rate to its effective lower bound at one of the MPC's forthcoming meetings during the course of this year. Today's announcement is the latest element of the bank's joined-up policy response to the referendum, a plan that was based on months of extensive analysis of the risks, detailed planning, and appropriate public communications. A plan that delivered a broad range of contingency measures to contain the immediate impact on the financial system of the result of the referendum. A plan that's already expanded the amount of credit available to the real economy. And now a plan that delivers a timely, coherent, and comprehensive monetary policy response that lowers the cost of credit and improves financial conditions for households and businesses across a wide range of channels. The Bank of England continues to stand ready to take whatever action is needed to achieve its objectives for monetary and financial stability as the UK adjusts to new realities and moves forward to seize new opportunities outside the European Union. And with that, we'd be happy to take your questions.
So, excuse me, as always, could you please give your name, the organisation you represent, and for the first go-round, stick to one question first, please. Emily first.
Emily Cadman, Financial Times. Governor, you've been clear that monetary policy can only mitigate but not cushion entirely the shock of Brexit. Is there anything the government can and should do?
Well, the first thing, Emily, is that obviously we can act quickly. And I think the bank has acted quickly across from contingency planning, the actions of the FPC, and now the actions of the MPC. So monetary policy is more nimble, and it's appropriate that it's the first responder to a shock. Clearly, the biggest elements of the change are structural. And monetary policy has to take those structural changes into account in setting policy, but it can't really do anything about those structural factors. So the biggest issues for government are those that they've acknowledged, which is the importance of the negotiations with European allies on the new relationship that will be developed, the importance of having a productivity plan, comprehensive productivity plan for the country. And it's within that context, or it's those decisions and those policies which will really be the determinants of the long-term prosperity. What we need to do in that context and in advance of those decisions is to provide the appropriate stance of monetary policy to ease the adjustment. We're governed by a remit, and in that remit we are governed by a trade-off and setting the right trade-off between getting inflation back sustainably to target and supporting output. And we, I think, have pretty clearly outlined in the report and with this decision how we see that trade-off and where we can provide support. Thank you.
Ed, and then Kamal.
Ed Conway from Sky News. Governor, you, in the inflation report, do not see the UK having a recession. Is that as a result of the action the bank has taken? Were it not for what the bank has decided today, would the UK have faced that recession a lot of people were concerned about in the run-up to Brexit?
Yeah, well, I think first is to re-emphasize how you started the question, which is our central forecast is for a relatively modest or period of growth initially second half of this year. We describe it as there will be little growth in the second half, but positive growth in the second half. That's our central expectation. And then the growth would pick up over the forecast horizon, aided by monetary policy, importantly, as the transmission starts to come through. Growth would pick up but to levels below that expected in May. So that's our central expectation. If we hadn't taken the steps we took today, we do expect output would have been lower, unemployment would have been higher, and we would have achieved a poorer balance in terms of returning inflation sustainably to target and foregoing output. Now, with all forecasts, there are risks on either side. It's possible that growth could be a little stronger. It's possible growth could be a little weaker. We have, in the actions that we've taken today, by acting through multiple channels with a coherent policy package, we have improved the economic outcomes for this country. There will be less unemployment, there will be more activity, and there will be a greater prospect of a successful adjustment to the new realities that the UK faces.
Kamal Ahmed from the BBC. Governor, given that the supply of finance possibly isn't the most serious issue facing the UK economy, how can you be sure that any of the measures that you have announced today will work and not just simply very marginal attempts at mitigating some of the effects of Brexit? And also just wondered, what's your message to savers who must be looking at the announcement today and thinking there is no point in me saving money for the future?
Okay. Well, the first thing is that we're living through a time of considerable uncertainty. And one thing we can do is reduce the uncertainties over the issues we have control. We have tremendous influence over the supply of finance, the price of finance in this economy. So the actions of the FPC a few weeks ago on the countercyclical buffer that built on years of building up the capital position of the banks have been absolutely reinforced by the actions of the MPC today to improve the price of credit, overall financial conditions. And I want to stress this point, which is that the MPC didn't just pick certain stimulus measures. It sat down, it thought through, had very detailed analysis, extensive conversations with the FPC, with the PRA board, to think through how various stimulus options would interact with not just the banks, but the financial system as a whole, and designed the program in order to determine that we would get the maximum amount of stimulus to households and businesses. That's why the TFS exists. And I will say as an aside, but it's an important aside, it's an example of the tremendous advantage of the structure of the Bank of England, that we are also the supervisors of these banks and building societies, and we can really get under the hood and understand how they will react to certain policies. So being clear about, with businesses and households, anyone watching, if you have a viable business idea, if you qualify for a mortgage, you should be able to get access to credit. This is not 2008, 9, 10, 11, 12, 13, and half of 14, okay? It's a different world. But that's enough in people's memories that it's important to take that off the table. Secondly, the stimulus measures we're taking are going to flow through. They're designed to flow through, and we've thought it through in terms of how, and we will be watching that they flow through. That has an effect. As with all monetary policy measures, it builds, it's an effect that builds over time. There's an immediate cash flow effect that people see, but it will build over time and have an impact over the forecast. Let me turn to your second. So we can control what we can control no more, and we're not going to ignore or step aside on those issues when it's our responsibility. With respect to savers, let me first say this is something that we think about a lot. There's a group of people who have worked hard, absolutely done the right thing, set money aside, and the returns are very low, and they're likely to be low for some time. That's true in the UK, it's true in all advanced economies. And the challenge is to get the economy in a position so it can grow sustainably at a higher rate. Those decisions will be determined not by the Monetary Policy Committee, but to go to Emily's question earlier, those are the big structural decisions that will be made by governments. We can support that adjustment, and we will ensure for savers, for pension funds, for insurance companies, for other pools of capital that ultimately are only there for the benefit of UK citizens, but for all those entities, that there will be a better economic outcome, that the economy will grow more, that there'll be fewer unemployed, and that ultimately we'll adjust to this new equilibrium faster and in a better way. And that's our contribution.
News. Governor, last week NatWest and RBS talked about their concerns about negative interest rates. This is something that you yourself have expressed many concerns about in the past. Can we now definitively rule out the possibility of negative interest rates? Because I note that in the report you say that you are currently bound to the lowest level of interest rates being just above zero, but I noted the use of the word currently.
Yeah, thank you for the question. Look, as you might have gathered, and you said in your question, I'm not a fan of negative interest rates. We see the negative consequences of them through the financial system. We've seen that in other jurisdictions. We see the issues with savers. It goes even further than the issues that were just raised with Kamal. We have other options to provide stimulus if more stimulus were needed. So we don't need to go to that resort. I think the MPC is very clear that we see the effective lower bound as a positive number, close to zero, but a positive number. And we will continue to be clear in our expectations on that. Let me say this about the banks. The banks have no excuse with today's announcement not to pass on this cut in bank rate. And they should write to their customers and make that point.
Phil Aldrich at The Times. Governor, I'll pick you up on that last point then. The banks have no excuse not to pass this on. It looks like potentially a £750 million bung that you're giving to the banks through the term lending scheme. This is through reducing their funding costs against that 1%, which you said is the average norm at the moment. Is it possible that you should, or are you considering wrapping this with a condition that around bonuses, with any conditions around dividends, to make sure that there is a sort of responsible approach here?
Well, I'd say a couple of things. There's two sides to this. One is that what we have seen elsewhere and what we see here as their supervisor is the squeeze that starts to come in on bank margins that then affects the price they charge on marginal loans. This is really about the new loans that they're making, the price they charge on new loans. That happens when interest rates get very low, very close to zero. So we've seen this movie. We've seen it elsewhere. We've seen the sequels elsewhere. We've been monitoring this for a number of years. We have very carefully calibrated the pricing and the sizing of the TFS to neutralize this effect so that in aggregate, there is no reward for the banks and there's no penalties for the bank. What there is a facility that ensures that they can fully pass through the cut-in bank rate. And by the way, it's fully pass through the cut-in bank rate to their customers. By the way, it's a facility that also means that we have some limited but additional flexibility to lower bank rate if that's required to support the economy. Again, in a way that further reduction would be passed through. So it's offsetting a squeeze that could be there, and it's an advantage of the structure of this institution, candidly, and the MPC listening to other parts of the institution, asking the questions and then listening to other parts of the institution, in that we're able to understand these dynamics and design a facility that does that. There are penalty rates if banks reduce lending, but I would stress this is really about, and your question is about, the transmission of those bank rate cuts to the real economy, as opposed to a scheme to incentivize certain amounts of lending. That was the old FLS. This is designed for a different purpose.
Larry and then Andy.
Larry Elliott of The Guardian. In his letter to you today, the Chancellor said he was prepared to take any necessary steps himself to boost the economy over the coming months. If he was to issue infrastructure bonds for public investment, would you have any objection to using the asset purchase facility to buy those bonds?
Well, the first thing I'll say is that, as you'd expect, since the Chancellor was appointed, he and I have met a number of times to discuss the economic situation, to discuss policy options. As you would expect, as you know, the Chancellor himself, or whoever the Chancellor is, he or she is, knows the broad outlines of an MPC decision prior to that decision. And of course, in the case of this decision where there's an indemnity being given for the asset purchase facility, we had extensive discussions of the possible decisions of the MPC. So we're fully aligned in terms of, or he's fully informed in terms of the MPC's thinking and the broader bank's thinking about what we can do to support this adjustment process. As you rightly note, he has been clear that he's willing to take any necessary steps to support the economy and reduce uncertainty. Those are the decisions for him and for the government, and they operate on a different time frame. With respect to, and we're not privy to those decisions, and as you can see in the forecast, we make no assumption about any change in the stance of fiscal policy, for example, in the forecast, this is as per convention, as we always do. We think, the MPC thinks this is the right package for today, so it's not appropriate for me to commit that we would countenance doing something else beyond what we have said, and the one thing we have said is that for a majority of members of the MPC, if the data over the course of this year comes in broadly consistent with the forecast in this inflation report, they would expect to move bank rate to that effective lower bound just above zero.
Andy and then David after.
Thanks. Andy Bell, 5 News. Governor, just to go back to the source of all this, drawing on all your experience, just how extraordinary was the problem with which you were presented by the Brexit vote?
Well, it's an unusual situation in the sense of it is a very large identifiable wish that there's an adjustment with the changed relationship with the EU, and then there's an adjustment which may happen at the same time or maybe slightly after with expanded relationships with the rest of the world. So we have to think about that supply shock and how that affects the economy today. That's a relatively unusual situation. What isn't necessarily unusual is to be in a position where there is a trade-off between supporting activity and the time horizon over which a monetary policy committee returns inflation to target. And one of the advantages of this system, having been operating on another system, one of the advantages of the system here is that we have to be very upfront and transparent about how we thought about that, which disciplines the committee, and we come out and are clear over what horizon we're going to bring inflation back and how we're going to support the economy. So that unusual is the supply shock. The trade-off isn't that unusual. The third aspect, which is somewhat unusual or exceptional, to use the language I've used today, is the fact that given interest rates are relatively low, and given what we now know about the interaction of conventional and unconventional policy with the financial system, it has been relatively unusual, or it has required some creativity or innovation in terms of the design of the package in order to get the right amount of stimulus in a way that will really affect underlying financial conditions.
David Smith, Sunday Times. Governor, one of the responses you may get to this from people who supported Brexit, and maybe even from some former MPC members, is that this was an overreaction, or is an overreaction, based on fairly limited evidence, and that it could even undermine rather than boost confidence because of the scale of the bank's actions. How do you respond to that?
Well, look, this is the appropriate response to the economic conditions in which we find ourselves. This is a response which will make this process of negotiation, transition, ultimately Brexit, it's going to support it. It's going to make it more likely to be a success, not just in the longer term, but in the nearer term. It's going to help with adjustment. There is a great degree of uncertainty. It's entirely understandable that there is. There's uncertainty about the eventual model that we will have with the European Union. There are a number of options on the table. Whichever model is chosen itself will require some degree of adjustment in the economy, and that brings its own effects on growth and productivity for a period of time. We are seeing, and I'm going to ask Broadbent to expand on this, we are seeing these risks manifest in a wide variety of indicators which actually in many cases are better indicators of what's actually happening in the economy than hard data, so-called hard data. And there is a clear case for stimulus, and stimulus now, in order to be there when the economy really needs it, to have an effect when the economy really needs it. So this is about cushioning the shock, supporting the adjustment, taking uncertainty off the table, and ultimately making this a success. But I might ask Ben to speak a bit to some of the data to go into it.
Yeah. Perhaps I can say to start with that there are sort of, in the information we get, degrees of hardness, if you like. Even the early official estimates of GDP I wouldn't describe as totally hard, in the sense that they get revised for many years afterwards. And many of these surveys continue to have information about what that final estimate of GDP will be many years from now, even after the ONS has started publishing its own earlier estimates. If you look at the chart on page 22, the top of that page, this is one of the more reliable indicators of activity, the SIP surveys. we've weighted the sectors here into one single series, or rather two, one for output, one for expectations. These are the steepest falls in both those series we've ever had. And they are both of them at levels we haven't seen since early 2009. They are reliable indicators, these and a few other surveys, and I would point out that if you took them at face value, they would suggest the economy is actually contracting. Now, we've aimed off that. We've aimed off it precisely because on occasion, even for these surveys, big shocks can lead to overreactions of things like this, and in particular the other confidence indicators. But we would need them to recover in coming months to meet the forecast we have, which is for a little bit of growth during the second half of the year. So I don't think it's premature to have acted in the face of weakening in these output surveys, weakening employment surveys, steep falls in some of the investment intentions against a backdrop in which investment was already falling, and also pretty steep falls in indicators of housing market activity.
Yeah, Louise Cooper, freelance. I was on Radio 2 yesterday, and a saver, a lady, doing a question and answer session actually for ordinary people, what this meant for them. And a lady, I think she was called Lucy, called in and she said, I've got £6,000 of savings. What do I do with them?
So we're going to leave that news conference there where the Governor of the Bank of England, Mark Carney, has explained the decision by the Monetary Policy Committee to cut the base rate of interest to 0.25%. That cut from 0.5% is the first time the rate has moved in more than 7 years, and it means the base rate is now at its lowest level in the bank's history. The bank also announced a package of economy-boosting measures. It's going to print money once more to expand its quantitative easing programme by £60 billion to £435 billion. That's the first QE increase since 2012. The bank is also buying £10 billion worth of corporate debt and has announced a scheme worth up to £100 billion to encourage banks to lend to households and to businesses. The bank kept its growth forecast at 2% for 2016, but sharply reduced the outlook to 0.8% in 2017 and 1.8% in 2018. Well, the Chancellor, Philip Hammond, has welcomed the decision to cut the interest rate and says he will take any action necessary to support the economy and boost confidence, he said. The vote to leave the EU has created a period of uncertainty, which will be followed by a period of adjustment as the shape of our new relationship with the EU becomes clear and the economy responds to that. The Governor and I have the tools we need to support the economy as we begin this new chapter and address the challenges ahead. So let's get reaction from our business presenter Ian King, who's in central London for us this afternoon. So Ian King, we expected a cut in the base rate of interest, but there's a whole package of measures to go with it. Quite a radical move by the Bank of England, it would seem.
Yes, that's absolutely right, Anna. And in particular, the decision to restart quantitative easing, buying back some £60 billion worth of UK government bonds, taking the total to £435 billion, Anna. And also buying corporate bonds for the first time. That was something that Mervyn King, the former governor, had very much set his face against. And this new term funding scheme. Now, interestingly, Anna, in the press conference where we've just been hearing from the governor, Mark Carney, he was at pains to stress that this isn't 2008, 2009 again, where of course, previously you saw the banks hoarding capital, you saw the money markets dry up, and the term funding scheme that the banks announced today, Mr. Carney was stressing there that this is really an enhancement of the funding for lending scheme. And the key quote in this, Anna, which I'll read out to you, when he was asked about negative interest rates, and he's previously made clear that he's not a fan of it, but obviously RBS NatWest has been hinting that if rates did go negative, they would have to start charging customers for that. They'd be passing that on. And Mr. Carney stressing that the term funding scheme he's announced will make it very, very easy for the bank to pass on those cuts to borrowers straight away. And he said, let me say this about the banks have no excuse with today's announcement not to pass on this cut in bank rate, and they should write to their customers and make that point. Mr. Carney stressing there that this isn't 0809, and he actually said, I want to take that off the table because it will still be in some people's minds. Interesting other points in that press conference, Anna. Our colleague Ed Conway asked him whether, had the bank not taken this action today, the UK would have gone into recession, and he basically said yes, there would have been a drop in output. So he's stressing that that is not going to happen now. As you said there, the bank is not forecasting a recession in the current outcome, although it is obviously forecasting a big drop in UK GDP next year and the year after. He was asked about inflation as well. Now, the bank is expecting an uptick in inflation. You would expect that, really, given the drop in the pound against both the dollar and the euro since the referendum. And obviously the bank's main mandate, the Monetary Policy Committee's main mandate, is to bring inflation to within a central element of 2%. And Mr. Carney said, were we to do that, the cost of doing that would outweigh the benefits. And he said it would be showing a total disregard for unemployment. Now, the bank is expecting some kind of increase in unemployment, but he was saying the cost of bringing inflation back to its target zone outweighs the benefits. Very, very interesting there. I think this term funding scheme, you're going to get a lot of commentary and analysis over this over coming days, but this is really a very, very significant development indeed. I can tell you some of the market reaction. You've just seen a chart there of interest rates over the last 10 years. I can show you what sterling's been doing on the foreign exchange markets. Here's the FTSE. The FTSE was trading in slightly negative territory. It's up by 1.5 percentage points there. Not really a surprise there, Anna. If the bank is bringing down the cost of borrowing and it's buying back UK government gilts, that puts money in the hands of investors, and they will put that money to use elsewhere. The expectation is it'll be the stock market.
OK, Ian, thanks very much indeed. So let's find out what people in Croydon make of all of this. Sky's Consumer Affairs correspondent Poppy Trowbridge is out on the streets there. So, Poppy, what kind of reaction has there been so far from members of the public?
Well, Mark Carney, of course, wants to put money in the hands of investors, but also in the hands of you and I, consumers. Big part of cutting the interest rate by 25 basis points was to encourage people to spend. And I'm in the very place where people come to buy big ticket items, sofas and carpets. They cost hundreds of pounds, sometimes even thousands of pounds. This is Purley Retail Park, and people come from as far away as Brighton to buy these big items for their homes. Come inside, I'll show you the kind of thing that I'm talking about here. We're talking about dining sets, sofas, chairs. This is exactly the kind of thing you might think twice about purchasing if you were worried about the cost of paying back that loan. But of course now, borrowing has become even cheaper than it already was. Mark Carney, of course, very aware that consumer confidence has had its sharpest fall since 1990 after the Brexit vote, and he wants to encourage people to continue to spend, to continue to enjoy their lives, and to know that they can afford to buy these big ticket items and furnish their home. And to talk about how businesses like this might benefit from this cut in the interest rate, I've got Andrew Ike, who's with me now. You're the regional sales manager. You see people come from all around to buy these big ticket retail items. Do you think that now that money's a little cheaper, you'll see an uptick in your business?
I absolutely think so, for sure. With regards to what we've just seen, with regards to Brexit, there was always a concern for anybody involved in business, but today's announcement has been exceptional in terms of to build the confidence that we know was low, but now, right now, I think the consumer confidence is going to be at the highest level that I've seen.
Fundamentally now, if someone wants to take a loan to buy a new sofa, which, let's be honest, do cost a hefty sum for people, it's a little cheaper for them. They can perhaps manage those payments. What kind of boost has it given specifically to, you think, your business in the last month? Because, as you said, post-Brexit, there was some concern that people would just hold off making that big buying decision.
Absolutely. So what we've seen, obviously within the furniture industry in the main, we're looking at between 30 to 80% of the consumers would take a finance option to make their purchase. We've seen a considerable difference in what our customers would use in terms of our financial package previous to now. In the last month, we've seen substantial increases in customers taking the financial options.
Because it is just more affordable for them now.
More affordable, and they're absolutely now convinced that there's nothing to be frightened about in the future. They know that they can go out there and spend money.
Fundamentally, that's what it's about. Certainty, confidence for consumers. What kind of confidence do you think it gives the businesses in this region?
Okay, so as a business, we are now extremely confident to steamroll ahead with our future plans of opening new units. We've got 3 new stores that we will be opening in the next month, and a further 2 by the end of the calendar year. For us, today's announcement tells us that we can continue with our plans.
So that means Mark Carney's achieved his goal, which is to increase business confidence, hope that trickles on to consumer confidence. Is there anything else that you need as a business to be confident that we will get through this post-Brexit period safely?
For us, I think the Bank of England have done exactly what they needed to do. It's now ensuring that, again, as a business, you never stand still. We continue to look at how we can improve our products and the experience that our customers demand these days. And we will continue to do that by looking at enhancing our ranges and enhancing, obviously, the options that the customers have to spend their money on.
Andrew Ike, Regional Sales Manager, thank you for joining us today. So borrowing was pretty cheap. Now it's even cheaper. The hope is that will spur consumers to go out and make these big purchases, and that money will help the whole of the UK economy make its way through this post-Brexit period. But I'll hand back to you now in the studio.
Poppy, thanks very much indeed.
I've been getting away with it all